So for this session, we will talk about sources of risk of material misstatement, that is fraud, error, and non-compliance. So generally, we have your ROMM, and we said ROMM is your inherent risk and your control risk. So part of your inherent risk and control risk, a contributing factor there is your fraud, error, and your non-compliance. By the way, non-compliance now is known as NOCLAR, non-compliance on your laws and regulations. So it's now NOCLAR. And NOCLAR is already part of a discussion of your code of ethics, and that was part of your reading assignment before. Now let's dive into your ROMM. So what is ROMM? ROMM, or your risk of material misstatement, which is composed of inherent risk and control risk, cannot be eliminated or controlled by the auditor because these are entities risk that exist independently of the auditor of financial statements. If you still remember, in your audit risk, we have three items. We have inherent, control, and we have your detection risk. We said when your detection risk, it is controllable by the auditor, but this IR and CR is given by the entity. So again, inherent risk, this is your inherent problems, let's say, and then let's say these are the risks, and then if you these are inherent risks, if you put internal controls, then whatever is left is your control risk. You do your substantive test, then whatever is left is your detection risk. Now, to obtain reasonable assurance about whether the FS as a whole are free from material misstatements, we look into also fraud and error. So what is the difference between fraud and error? Whenever the act is intentional, then it is fraud. But if the act is unintentional, that is an error. So normally, if that is an error of omission, we say it is fraud. But if it's a error of omission, we say it's error. If it's an error of commission, it's fraud. Again, if it's an error of omission, normally that is error only. But if that is an error of commission, then that is already a fraud. Because when it is committed, meaning it is intentional. When it is committed, it means it is intentional. So fraud can be further broken down into two. We have your fraudulent financial reporting and your misappropriation of assets. You always know that fraudulent financial reporting is also known as management fraud, and misappropriation of assets is known as your employee fraud. Now, what is the difference of this type of fraud? For fraudulent financial reporting or management fraud, these are intentional misstatements of your management over the FS. Okay? Management fraud is normally intentional over the FS. The effect is on the FS. The amount on the FS, disclosure on the FS, or earnings on the FS, etc. While if ever that is theft, we call that misappropriation of assets. So that is intentional taking of assets of the entity. We call that misappropriation of assets or employee fraud. Now, let's try to discuss and differentiate the two. So we have these two types of fraud. We have management fraud and we have your employee fraud. So for your management fraud, it is an intentional misstatement of the FS. Take note, you have the intention to deceive users. And how do you deceive the user? Through the use of the financial statement. That is either you bloat the amounts of your FS, your assets, decrease the liabilities, or increase the earnings. Ultimately, the goal is to deceive the users through the FS. So common examples of your management fraud is manipulation, falsification, or alteration of accounting records. Any misrepresentation of events or transactions or misapplication of accounting policies, which ultimately will yield to the increase of your assets, decrease of your liabilities, or increase of your earnings. And these are all items of your financial statement. But if that is to conceal or to misappropriate assets purely, that is employee fraud. So whenever it is a theft on entity's asset, again, you only misappropriate asset or you conceal the asset, then it's employee fraud. Now, how do we conduct employee fraud, or how does the employee conduct employee fraud or misappropriation of assets? That is by false or misleading records or documents. So let's say, for example, you have a collection. So you have a collection that is an AR. So you don't record the collection. What you do is you recorded it as a bad debt, perhaps, or you recorded it as a return, perhaps, etc. So that is one way of employee fraud. So we try to cover the AR by misleading the records or changing the documents. So here, it should have been a collection of debit, cash, credit, AR, but you recorded it as a bad debt or you recorded it as a return. So you debit a sales return, you credit AR. That is to conceal the employee fraud or misappropriation of asset. Take note again, we have two, right? Two issues or uh, two reasons why there is ROMM. We have error and then we have fraud. And under fraud, we have now management fraud and we have your employee fraud. Please do not forget the the other term for management fraud. Management fraud is financial reporting, fraudulent financial reporting. And then for employee fraud is known as misappropriation of assets. Okay, so how do we do or how does the employee do employee fraud? Again, first, steal something that is an asset, convert that asset into cash, and conceal the crime to avoid detection, just like our example earlier. So we have an asset AR, you convert it into cash, you conceal it by recording a bad debt on that AR or recording a return on that AR. So let's differentiate fraud and error. Again, we said your error is unintentional, but fraud, whether management or employee fraud, is intentional. So what is the intention in management fraud? Again, to deceive users over the financial statement. You bloat the asset, you decrease the liability, or you bloat the earnings. While for employee fraud, that is the intention to conceal the asset or to misappropriate the asset. Now, how do we commit error and fraud? For error, it is committed by mistake because it is unintentional, while for fraud, it is committed by override of your controls. Employee fraud is committed by theft of entity's asset. Now, what is the impact of an error? For the nature of your audit procedures, you have less extensive. The timing to check the error is during interim period, and the extent is lower samples and procedures. But if that is fraud, you have more extensive nature of audit procedures. It is normally period end or closer to your period end. And then the extent of your procedures is highly extensive with higher number of sample. So who has responsibilities or what are the responsibilities over fraud and error? For those charged with governance and management, they have the responsibility to prevent and detect fraud. Take note, prevention and detection lies with the management or those charged with the governance. It is incorrect to say that the auditor must detect the fraud. Who should detect the fraud? It is the management and those charged with governance. How about the auditor? The auditor does not really look into the fraud. Whenever you just uncover it during the whole process of audit, but generally it is not directed towards uncovering or detecting fraud. Okay, so for TCWG, you supervise the performance of the management, and for management, you perform the day-to-day functions of the business to look for a possible fraud. And then what are the specific responsibilities? Again, you provide a particular tone at the top that there must be no fraud in the organization. So that is by emphasizing your control environment. And when we say control environment, again, we have discussed it earlier that there must be a commitment as to the entity for ethical values, and that ethical values should pertain properly to the individuals concerned, to the company or business, so that at least you deter fraud. And then you maintain that internal control. So ultimately, how do you address fraud? It is through internal control. And how do you detect fraud? It is dependent on the management, on how do you detect the fraud. Now, for the auditor, what is the responsibility of the auditor? That is to identify and assess use of material misstatements due to fraud. That is to obtain sufficient appropriate evidence about this ROMMs due to fraud through designing, implementing appropriate responses. So how do we respond? So we look into the overall objective of the fraud. And then you consider the inherent limitation of an audit in the context of fraud. That fraud is greater than error, and management fraud is greater than employee fraud. What do we mean by that? That fraud is harder to uncover rather than error. Because for error, easily you can look that up, especially if that particular error is routinary. But for fraud, since it is intentional, it is really conceived and predetermined, then it is very hard to uncover it. Now, um, as to fraud, between management fraud and employee fraud, it is harder to look for management fraud. Why again? Because you are now overriding the control. And it is the upper management who tries to cover up that particular fraud. So it is very hard to uncover it. Now, how do we communicate the fraud? Generally, you communicate it only to the management and those charged with governance because are your reporting entities. However, you cannot report it to outside entity because, again, of confidentiality clause. So just in case you uncover fraud, you report it to the those charged with governance and to the management. Due to the confidentiality clause, you can only report to them. And the auditor must maintain professional skepticism throughout the whole audit process so that we can uncover any possible fraud or error. And then you discuss with the engagement team if ever during your risk assessment process there is a possibility of fraud. Now, how do we assess fraud? So in your fraud risk assessment, you do the following risk assessment procedures. It's still the same way. We do IOI, inquiry, observation, or inspection. So first, you inquire with management, and based on the inquiries on the management, you can possibly look into whether there's a fraud. You also inquire to the internal audit for any actual, suspected, or alleged fraud. You can also obtain understanding on how those charged with governance oversees the processes relating to fraud. Again, inquiry with those charged with governance on any actual, suspected, or alleged fraud, and considering any other information based on your inquiry. And you now evaluate whether fraud risk factors are present. So how do we determine whether there is a fraud risk factor? Our fraud risk factor is determined based on our fraud triangle. If you still remember, your fraud triangle is composed of three items. So we have your opportunities, pressures, and then we have your rationalization. So based on these three items, possibly there can be fraud. If the three items are checked, then there can be fraud. So if there is ROMM due to fraud, then we said that is a significant risk. And if that is a significant risk, then there is no control that could possibly detect that particular risk. Then you determine now the NTE of your substantive test, the nature, timing, and extent of your substantive test. And we said you need to allocate this one to experienced team members because, again, experienced team members could possibly deter or uncover fraud based on your NTE. So fraud triangle, again, this is what we use to determine the fraud risk factors. First, we have your incentives or pressure. That is to get something by committing fraud. And an opportunity is unlocked for you to do that fraud. These are circumstances within the company to commit the fraud. And then lastly, attitudes or rationalization. These are causes the management or employees that the fraud is just proper or we are really to commit this fraud. And once these three items are present, again, if you can tick mark these three items, possibly there is a fraud risk factor. Therefore, you have now a significant risk. Okay. So how do we do our audit procedures? So in your risk assessment process, again, you look into fraud risk factors, and then you look now into the result of your risk assessment process. If there is a suspected fraud, you look into the effect of that suspected fraud in the FS. So look into the effect on your assets, your liabilities, your equity, or possibly on your profitability or earnings. And then you discuss with those charged with management that particular fraud, regardless whether it is material or immaterial. If it's immaterial, you advise management to pursue with identifying the suspected fraud. But if that is material, you need to have a sufficient appropriate audit evidence that the financial statement is free from material misstatement due to fraud. Take note if that is immaterial, then we can brush it off. Why? Because in our audit report, we say that the financial statement is free from material misstatement. Therefore, once it becomes immaterial, generally, we don't look into sufficient appropriate audit evidence already. Why? Because we can just brush it off. It is within our acceptable audit risk. But once it becomes material, then we need to remove that material misstatement because we should say that the financial statement must not be materially misstated. But if that is not removed, then we must modify our report. Take note, our main objective for the audit is that the FS is free from material misstatement. But once there is fraud and it is material, and there is no sufficient audit, there is no sufficient appropriate evidence that the fraud was properly taken into in the financial statements, and that the financial statements now is that the error now due to fraud is immaterial, then we can still provide for unmodified opinion. But if not, then we need to modify our report because the FS now is materially misstated. That is as a suspected fraud. But what if it is identified fraud already? If that is identified fraud, then again, same. You request for adjustment because we don't want a materially misstated financial statement. And then, if ever it is not modified still because of that fraud, then we said we need now to modify our audit report because the FS now is materially misstated. Or if ever you cannot obtain enough audit evidence, then you can either modify your opinion through disclaimer of opinion. Now, how do we communicate and document the fraud? We said earlier, if that is merely a suspected fraud, you discuss it those charged with governance, and then you discuss it also with management. But you should not communicate that to other persons because of confidentiality clause. But if the court will require you or the law will require you, you can disclose. But if not, you cannot. Why? Because of confidentiality laws. So when do we communicate to the management? You communicate to the management as long as the matters are already uncovered by the auditor, and you communicate it to the appropriate level of management. Next, to those charged with governance, when the auditor has identified fraud and the fraud results in material misstatement in the financial statements, because normally this results in a significant deficiency in the implementation of internal control. And if that's the case, it is the governing body or those in charge at the top who should properly remedy that deficiency in internal control. And lastly, on your regulatory bodies, again, you will only report to the regulatory bodies if the law requires or the court requires you to report. If not, do not report. Why? Because of confidentiality. Again, do not report as a rule because of confidentiality, unless the law requires you or the court requires you to report it. Now, how do you document it? Your documentation is as to the understanding of the entity and its environment and the ROMM due to fraud. And then what is your response to that risk of material misstatement? So meaning the nature, timing, and extent of your audit procedures. And how did you communicate about the fraud? Your communication, whether to the management, to those charged with governance, or to the regulatory bodies. And then lastly, when the auditor concluded that the presumption that there is ROMM due to fraud related to revenue recognition is not applicable in the circumstances of the engagement, the auditor should document the reasons for that conclusion. Okay. Now, if the auditor thinks that the ROMM due to fraud relating to revenue is not applicable, you must document it always. Why? Because if the fraud relates to revenue, that is a management fraud. And take note, management fraud is harder to uncover than your employee fraud. And if you think that management fraud is inexistent, then you need to document that. You need to document that based on your testing on the revenue recognition or the controls in place on that revenue. Again, because of the inherent risk that management is greater than employee fraud, that is harder to determine than employee fraud. So you need to document your reason why you think that there is no management fraud. Next, we have your NOCLAR. So NOCLAR is non-compliance on your laws and regulations. So these are acts, omission or commission, intentional or unintentional, committed by the entity or those charged with governance, by management or by other individuals working for under the direction of the entity, which are contrary to laws and regulations. As long as it is against law and regulation, we call that NOCLAR. So what is the responsibility of those charged with governance and management? It is the responsibility of the management and those charged with governance to ensure that, of course, you are complying with laws and regulations, meaning the particular entity must be compliant with laws and regulations. And how about auditor? The auditor must obtain sufficient audit evidence regarding compliance with your laws and regulations with direct effect on the material amounts and disclosures in the financial statement. Take note, generally, we only have financial reporting objective that we are testing, but we also test compliance objective only if ever it has an effect on the FS. We already discussed this earlier when we discussed your internal control. You can only test those items that has direct effect on the FS. Therefore, if that is a NOCLAR, you only test those with direct effect on the FS. Those with direct effect on the FS. So let's say, for example, uh, revenue regulations tell you that you should disclose the items of your vatable sales. Then, therefore, that revenue regulation has a direct effect on your FS, particularly on your notes to financial statement. Therefore, you test whether there is NOCLAR on that particular disclosure. Next, to perform specified audit procedures to help identify NOCLAR with other laws and regulations that have material effect on the FS. Always test only compliance on laws and regulations whenever it has effect on your FS. And then ultimately, to respond appropriately to non-compliance or suspected non-compliance with laws and regulations. So just like your fraud, it could be an actual fraud, which is an unidentified fraud, or a suspected fraud. And this, whether it is suspected or identified, we determine the effect as to how we will properly properly identify the effect of that fraud in the FS, and how do we communicate that to those charged with governance or to the management. So let's look into your audit procedures on your NOCLAR. So your risk assessment procedure, we look into whether, again, it materially affect the FS. And we just understand whether it has a material effect on the FS. So if it has a direct effect to the FS, you identify the effect to the FS. And you request management representation letter that that particular item was placed in the FS. So for example, earlier we said we have a revenue regulation, or the law requires that there must be a disclosure on the VAT or to the amount of your sales. Now, we look into the FS if there was really a disclosure. If there's a disclosure, the management must represent in a management representation letter that it was properly disclosed. Now, you discuss with the management if ever the management do not provide information relating to that NOCLAR, or the information cannot be obtained. Now, if you cannot provide, if the management do not provide enough information, then you consider the effect of that by looking into a legal advice. Because why? You are already at the end of the audit process by this time. And if ever that is NOCLAR, you look whether you can just modify your opinion, or you look into the effect or any legal effects of that possible NOCLAR. Next, the auditor shall evaluate the effect of lack of evidence on your auditor's opinion. So if you cannot obtain the necessary or the sufficient appropriate evidence, then you can modify the opinion. Now, what if the NOCLAR, again, we determine whether the NOCLAR has direct effect to the FS or no direct effect to the FS. If the NOCLAR has no direct effect to the FS, then you just perform specified audit procedures and request for representation letter. Generally, you don't look into or you do not check already that. Why? Wala naman siyang epekto sa FS natin eh. Therefore, wala na tayong pakialam doon. We only look if ever it has an effect on our FS. Then, you discuss with the management for any possible NOCLAR. But if no direct effect, just a management representation letter, that particular law and regulation does not affect the FS, should be given to the auditor. Now, how do we communicate and document NOCLAR? So to those charged with governance, if ever auditors suspect that the management or TCWG are involved, then you don't communicate to TCWG. You communicate to next level of authority. And generally, that is a legal advice if the next level of authority does not exist. Why? Because if the NOCLAR is done by the management, it would be futile to discuss it with the management because they were the one who committed that non-compliance. If the non-compliance was done by management, you report now to those charged with governance. Now, what if those charged with governance are the ones liable for non-compliance. Then, wala nang mas tataas doon. You now seek legal advice. And whenever you seek legal advice, you look into the legal repercussions of non-compliance. Now, you can also communicate in the audit report. Depending on the materiality and pervasiveness, again, you can modify your report, either qualified, adverse, or disclaimer. And to regulatory bodies, if the law or court require. Again, you can only report to regulatory bodies if the law or court require. If not, then you should not report because, again, of confidentiality. Now, what should we document if there is no NOCLAR? Any identified or suspected NOCLAR, just like your fraud. What is the audit procedures or what are the audit procedures performed? Normally, nature, timing, extent, and any discussion made. Just like earlier when we discussed your fraud, what are the items communicated? Again, your understanding, and then the response, and how did you communicate or discuss that response? Just like now in NOCLAR, the same way we communicate or document what are the NOCLAR items, your audit procedures, and how did you discuss these items to the management, TCWG, or if practicable, whenever you seek legal advice. Okay? So again, your ROMM your ROMM comes from either error or fraud. These are contributory to your ROMM. So for fraud, we have your management fraud or your employee fraud. Now for fraud, take note, whether it is suspected or identified, you need to properly document it. So for suspected, if that is immaterial, wala, pabayaan mo na yan. Pero pag material, i-check mo. Look for sufficient appropriate edit evidence. Now, if that is identified, then there must be now proper corrections done. And then, if there's no correction, you can now modify your report. Now, we also have NOCLAR or non-compliance on your laws and regulation. So for NOCLAR, generally, what we do here is we look whether a particular law or regulation has an effect on FS or no direct effect on FS. If it has direct effect on FS, then you must gather sufficient appropriate audit evidence. If no direct effect on FS, then you can ignore that. You can just ask for management representation letter. Now, if you don't get sufficient appropriate audit evidence or the FS is materially misstated, again, you can modify. Always remember this, whether fraud or NOCLAR, if the law or the court does not require you to report, then you do not need to report because of the confidentiality rule. Okay? So that is your risk of material misstatement due to fraud, error, and non-compliance.